All right, why don't we get started? So thank you guys very much for joining. My name is Mark Lamonica. I look after the individual investor business here in Australia. And today we're going to talk about income investing, which I know is a popular topic for everyone. So yeah, hopefully we get lots of questions. Margaret asked if I was related to Santa Monica, like Santa Monica, like the city in California. Good first question. We have to go through our housekeeping items first. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you are in New Zealand, you can find our FAP on morningstar.com.au. And the New Zealand regulatory authorities encourage you to go speak to a financial advisor if you do want personal advice. I would like questions. They can be questions about who I'm related to or cities. I guess in that case, both. But yeah, questions would be great. So just send those through and we can get to those. All right, so let's get started. Very organized today. I have the slide ready to be shared because I'm in the office alone, of course. I had to move the camera around, so Will's on here, normally our videographer. But Will, I moved the camera back. I felt like it was too close to me, so I don't know. Let Will know what you think about the shot if I should be the videographer and he can be on here. All right, so we're gonna talk about income investing. First, let's talk about why it's so attractive. So that is Jimmy Buffett. I wanted to include a Buffett in here other than Warren Buffett for once, but why is income investing so attractive? We have two celebrity guest stars on today's webinar. Jimmy Buffett is one of them, looking very much like the 70s, which is when that photo is from. So why is passive income so attractive? Well, it's attractive because it's everybody's dream that their portfolio will generate income, which they will be able to live off of. So instead of exchanging labor for a paycheck, you can exchange capital in terms of your portfolio for income. And so the dream is then you can do whatever you like. And I'm obviously not going to talk about that quote at all, but I really like the quote because I think it's true. But anyway, yeah, passive income. So people are very, very interested in passive income. And that's why hopefully this will be a popular topic today. So passive income, of course, is income that's generated without you actually having to do anything like go to work. So that's why people like passive income. Okay, let's talk about the different places you can get income. This is our second celebrity. That's Tina Turner. So yeah, star-studded event today for our webinar. So why do we have Tina Turner on there? Because there's this notion now that there is no alternative. What does that mean? It means there's no alternative. Tina, so see that spells out Tina. I should have capitalized these so it's more obvious. There is no alternative to investing in equities right now because you get nothing from the bank, almost nothing from fixed interest. But let's talk about the different ways that you can generate passive income. Now, we're going to spend most of today talking about stocks and dividends, but I want to start off and look at all the different categories you have. All right, you can, of course, invest directly in domestic shares. So shares trading here in Australia. What are the advantages of doing that? Well, there's more. Oh, God, I spelled funds wrong. Not FUDs, funds. Sorry about that. There's more predictability than ETF or funds. So maybe that's a little bit of a controversial statement, but we'll get into why I think that's true. So more predictability about the income that you're actually going to generate. The other thing is, of course, that you get franking credit. So we'll spend some time talking about franking credit. So when I showed up in Australia, I learned about at least the obsession with franking credits, obviously a little bit controversial. I won't talk about that part. I'll just talk about what they are and what they mean to you as an investor. What are the disadvantages of domestic shares? It's more difficult to diversify your income, of course, because your income, if you buy one company, so one share, you're getting everything from one company. If you want to diversify, you got to go out and make a bunch of trades and build a portfolio. The other thing, domestic shares. So there's a lot of concentration in Australia, obviously in certain industries. So resources and financials, basically about 50% of the ASX 200. So that concentration can be bad if you're trying to diversify your income sources. Because if something bad happens to the iron ore price and we have something that bad happen to the banks, you could be in trouble. Very domestically focused. So Australia, companies that trade in Australia have more of a domestic focus than international companies. What does that mean? It means they get more revenue from domestic sources here in Australia than they do from international sources. Now, that doesn't mean there are not international companies in Australia, but something to think about. So once again, if you're trying to diversify your income sources, you are very reliant on the local economy. All right, global shares. So, of course, you can buy individual shares overseas. Easier and easier to do now, given the fact that there's all sorts of low-cost ways to do it, and most brokers offer access to direct foreign markets. So, once again, more predictability than ETFs or funds, if I knew how to spell. And I'll talk about that in a second. You're able to diversify your income from a wider variety of sectors internationally and countries, of course. So that's that notion that you want to diversify those income sources, not have it all reliant on the Australian economy, for example. And the advantage of that, of course, is you are probably very reliant on the Australian economy with a job, housing prices, things like that. Well, you can diversify your income sources elsewhere in case something goes wrong here. All right, disadvantages. Once again, difficult to diversify. You got to build a portfolio. No franking credits. So, of course, you do not get franking credits for companies that are global. In general, you get lower yields internationally than Australian shares. So when we talk about franking credits, we'll also talk about payout rates. Basically, in Australia, you get higher dividends than you get in foreign markets in general. Now, there are obviously some tax reasons for that, which creates investor preference. But yeah, you generally get higher yields locally. Currency impact on income. So currency movements matter, just like any sort of investment overseas, that depending upon how the Aussie dollar does versus whatever country you're investing in, those currency movements are going to have an impact. Now, because I always say this because people get a little confused around currency sometimes. So if you're investing in US shares, for example, trying to derive income, dividends from US shares, and then spend them locally, you want the Aussie dollar to get weaker against the US dollar. That makes your income worth more. So remember, the opposite can happen. It happened for a lot of last year after March. The Aussie dollar got a lot stronger against the US dollar. So what does that do? That would lower your income. So you just got to take currency into effect. All right, let's talk about ETFs and funds, or FUDs, as I called them. So equity ETFs. So it's easy to diversify in both ETFs and funds, right? Because you can get an entire portfolio in one trade or one investment in a fund. The problem is there's a lot less predictability because in income. Now, part of this is just nuance. It's not really income, but the problem with ETFs and funds is they both distribute capital gains to you. So what does that mean? That means that if a capital gain, so if a share is sold for more than the fund or ETF bought it for, if a capital gain is realized within a fund or ETF, that will be given to you through the distribution. Now, the problem with this is, and in every sense of the word, like there's an income portion and there's a capital gains portion, is that people get very confused about this. And I've seen this a lot lately all over these investing message boards where people are talking about they got these great, and they call them dividends. They're not dividends, they're distributions, but they call them dividends. They're like, oh, my, speculative thematic ETF had a giant distribution. And then a lot of people just think, okay, well, I'm going to get the same thing next year. Well, you may not, because a lot of that is capital gains. So number one, you're going to pay taxes on it. So just remember that. But these giant, and we've had really big ones this year because the market's been up so much that a lot of the rebalancing that's occurred in these funds or ETFs, when they have sold the winners to buy the losers, basically to rebalance, if you're like in an equal weighted one, or they have some sort of strange balancing, particularly around these thematic ETFs, which are often equal weighted, you've had these huge distributions. So what I want to say is that's not income. So a lot of people want, especially if you're looking for passive income, if you want to go back to being Jimmy Buffett, if you want this passive income, or be like Jimmy Buffett, he makes a lot of money for other people that want passive income. You're not going to get predictable distribution levels every year because of this capital gains component. So in years like this, it's really important to not sit there and count on that next year, because a lot of people like to have smooth income because it reminds them obviously of their salary, which is hopefully smooth. And then obviously makes it easier to live your life, right? If it's predictable where your income is going to come from. So both a problem with ETFs and funds. Hybrids. So what's a hybrid? A hybrid is a security that has both debt and equity characteristics. So why do people like hybrids? Well, number one, they generally offer higher income than fixed interest. And we'll talk about why in a second. We're not going to spend too much on hybrids today. They also have lower volatility than equity, so they don't bounce around as much in price. So they're very attractive, particularly obviously to people approaching or in retirement, because what do you want when you're approaching or in retirement? Lower volatility. You want your portfolio to bounce around less because you're worried about sequencing risk, and higher income because you're starting to take money out of your portfolio or preparing to take money out of your portfolio. The other thing that people really like about hybrids is franking credits. All right, what's a disadvantage from a hybrid? Well, number one, they have higher credit risk than fixed interest. They also have lower expected returns, which I haven't really focused on because this is income. So let's explain hybrids and fixed interest. So basically, a company will have a capital structure, and some securities are subordinated to other securities. So what does that mean? It means if the company goes out of business and they're selling off the assets, the first people they're going to pay are bondholders, and they're going to look at where they stack on that sort of preference list for who gets paid the money. So hybrids are lower. That means they offer a higher interest rate to compensate you for the fact that you are less likely to get your principal back if the company goes out of business. So you get a higher interest rate, and you have higher credit risk, right? Because it's like you're further down the line in terms of when you're going to get paid out if the company goes out of business. Now, if you buy shares in that company, you are last in line to get any money if the company goes out of business. Now, most hybrids are issued by large banks because there's advantages for them in terms of their ways that they have to hold capital from a regulatory perspective. So banks issue a lot of hybrids. So, you need to sit there and think, is Westpac going to go out of business? If you don't think they are, then you're a little less worried about sort of where you sit on that ladder in terms of when you're going to get your money back. And also because they're issued by banks, banks are some of the most regulated businesses out there. So you'd hope they wouldn't go out of business. Then, of course, fixed interest. So fixed interest, you have a lot more predictable income. And the reason you have that is because it is a contractual obligation of a company or a government. Doesn't mean they can't go out of business and default, but they have to pay you, whereas a dividend is a choice by management. They can choose to issue a dividend or not. You have to pay back your bondholders. If you don't, then you have to declare bankruptcy. So either way, then you're in trouble as a bondholder. All right, we've got a couple questions. Hopefully about Tina Turner. No, they are not. So somebody's saying that they can't hear my voice. So hopefully other people do. And then somebody's making fun of me or Harry or somebody. So thank you, Anthony, for that. All right, so John's asking question: where would you classify corporate bonds? Okay, so let's think about fixed interest when we're talking about income. So basically, fixed interest, you are looking at credit risk. Credit risk is going to drive the level of interest rates that you are going to get in general off of a fixed interest bond. So what does that mean? It means the safest bonds will pay lower amounts of interest. More bonds that have more credit risk, so investors are worried that the company may not pay them back, or the country, depending upon what country it is, then you're going to get higher interest rates. So generally you start with government bonds. U.S. Treasury bonds are generally risk-free. Australia's AAA, those are very, very high credit quality bonds, mostly because if you're a government, you can just print more money to pay off your bonds. Now, that would cause all sorts of other problems, but anyway. So you're getting low interest rates, the lowest interest rates on government bonds. Then companies, so corporate bonds that issue, companies that issue bonds, they are going to have higher interest payments that you get, but you're going to take on more credit risk. And then it depends upon the company and what investors and what the credit rating agencies believe the chances are of them defaulting. So you get into high yield bonds. So high yield means you get more interest. They're also called junk bonds because people are very worried that they may not actually pay you back, right? So they have to give you back your principal at the end. Then you're getting potentially very high interest rates. So a rule of thumb is, and you see a lot of this stuff. There's all these different sort of funds that have, and LICs and things like that have come out that do have less credit-worthy bonds in them. Doesn't mean they're going to default, that are giving you higher interest rates. So the first thing you should do with bonds is if you're getting a pretty high interest rate, you need to go check the credit quality because you know that's why you're getting it, right? There is no secret why you're getting higher credit risk. So some of these like bundling of corporate loans and things like that, the reason you're taking on risk. So just realize you're taking on risk. That's why you're getting a higher interest rate. So something important to remember. All right, so we are going to move on to, and I'll get to your question in a second, Matthew. It's a good question, but I'll get to it when I get on the website. So just give me one second. Okay, we're going to move on. So say goodbye to Tina. We're going to talk about franking credits because, of course, we have to talk about franking credits. Now, obviously, franking credits, particularly in the last election, became a bit of a political issue. There's a little bit of generational conflict between people around franking credits. I'm not going to talk about any of that. I know people are very passionate on both sides about that, but let's talk about what a franking credit is. Okay, so basically, at the end of the day, what a franking credit is going to do for you is going to increase the income that you receive from shares. So there is a notion that you are getting double taxed on dividends. So, and basically where this notion comes from is pretty simple, right? If you own a share, you own a company. You are an owner of a company. Just like if you own the corner store in your suburb, you own that corner store. So when the corner store pays tax on something, or when the company pays tax on it, you're paying tax because you own the company. So then, from a company perspective, and I'll get back to the corner store example because sometimes that helps. So if the company pays tax on something, then they give you part of the profits of the company you own, and you pay tax on that. The notion is that is double taxation. Just like if you own the corner store, and the corner store paid taxes on money it made, and then you took money out of the business you own to support your life, you shouldn't pay taxes on it, right? Because they've already been paid. So that is the notion behind franking credit. So basically what a franking credit is a franking credit is the credit for the taxes that the company paid get passed on to you as an investor. Now, there's all sorts of other controversial things about franking credits I'm not going to get into in terms of like getting refunds for the money if you don't pay taxes, things like that, which is where the controversy is. But basically what a franking credit is it is enhancing that income that you are being given by getting a credit from the company. So let's look at what franking credits have done. Okay, so what we have here is we're looking at three different things here, all ASX 200 related. Okay, so what do we have? We have the ASX 200, this line right here. So that just represents the price movement of the ASX 200. Then we have a total return. That means we're including dividends. So what you can see here is that dividends make up a very big part of the return that you are getting, particularly of the ASX 200 because dividend rates are higher. Then up here, this, I think, yellow line, I'm colorblind, so I struggle with this. I struggle with most things in a day-to-day basis, but you know, this as well. What you're seeing with this top line is you are seeing what you get when you get those franking credits. We're basically adjusting those returns for franking credits. Now, what do you get? So basically, over the last 10 years, you got an extra 2% on the compounded annual growth rate of the ASX 200 because of franking credits. So remember that. Franking credits are juicing your returns. So something to think about. Oh, we're back to Tina. And we're back to Buffett. I'm going the wrong way. Okay, so let's move on. And oh, geez. Okay, so Shawnee made this slide. So I apologize for this. That was an old picture. And yes, I was drinking Passion Pop because somebody thought it'd be funny and gave it to me. Okay, so we're going to talk about dividend reinvestment plans, which is the next topic. So what are those? So dividend reinvestment plan is basically just every time you get paid a dividend, you are going to get more shares of the company you own instead of just getting the cash. So it's a choice you can make. And dividend reinvestment plans do two things, which are very powerful as an investor. So they lower your cost base. I'll explain in a second why that happens, but they also allow you to compound that income you're getting even more. So pretty important. So let's talk about how they lower your cost base. Now, to be honest, they do not lower your cost base in terms of taxes. So don't think I'm telling you that. But what they do in a practical sense is they lower your cost base. All right, so let's see if Shawnee did a good job on the slide. So, all right, let's say you buy 100 shares in my bourbon company, which would be great, for $1. So what are you doing? You're spending $100 on that. So what is your cost base? It's $1, right? You have 100 shares, you spend $100 on that, and we're yielding 5%. What happens in a year if the share price does not change? In a year, you've collected 5% of your investment in dividends, which you've then reinvested back in shares. So now you have 105 shares, all right? So effective cost base, you spent $100 on your shares, now you have 105. So what it has done is that's supposed to be 95 cents. So Shawnee is sick today because she got the AstraZeneca jab and doesn't feel very well. But anyway, I can talk to her tomorrow about that. Yeah, 95 cents. So basically what that is effectively lowering your cost base. The other thing that it's doing, of course, is juicing your dividends, because remember, you have more shares now. So if you get the same dividend per share, you get even more money. We've got an example of that on the next slide. All right, thankfully, we are done with the picture of me. Well, Matthew says, Passion Pop, aka $2 Chuck. Yeah, I never heard of Passion Pop. And I'm an Australian citizen now, but before I became a citizen, I was told I had to do 4 things. These are unofficial things. The government didn't tell me this. Basically, Shawnee told me this. I had to have Passion Pop. I had to do a shoey. What are the other ones? Geez, now I'm forgetting them. I had to play that game where you spin the, clothesline thing, which I haven't done yet. So maybe I'm not officially an Australian. I don't remember the last one, but that was important too. Okay, we're gonna do a bit of a case study that's going to show you the power of reinvesting dividends, and what it's going to do is going to show you the trade-offs that you need to make as an investor. If you are a dividend investor, a very important trade-off that you are making, we'll talk about yield traps in a second, is you need to decide, okay, am I going to try to find a company that I think is going to grow dividends, or am I going to try to find a company that pays a really high dividend right now? Now, a lot of people, when they start thinking about investing in income, and I totally understand where this comes from, they will sit there and they'll say, okay, if I'm going to invest for income, the best thing to do is I'll just go look at all the shares that are available and I'll buy the ones that have the highest yield. So a yield is the dividend divided by the price. That means you are getting the most back every year. If something yields 10%, which is very high, something yields 10%, that means if I invest $100 in that share, I'm going to get $10 every year. Okay? So a lot of people fall into that trap, and it's called a yield trap, where they just go for the highest shares. But if you're trying to grow your income over time, mathematically, at a certain level, it makes a lot more sense to go in and invest in something where the dividend is growing. So the advantage of dividends over a bond, for example, is that dividends can grow. They are a choice by company. They are a distribution of some of the profits the company makes. So if those profits are growing and management wants to return more cash to shareholders, those dividends can grow. So let's look at Transurban. So this is a real example that I did a couple of years ago, which took a long time and it was annoying. All right, so here's what we have down on the left. We have all of Transurban's dividends between 2009 and 2018. All right, so you can see the different dividends. So generally in Australia, you get 2 dividends a year. US, 4 dividends a year. Just different ways people go about things. All right, so you have 2 different choices. You can take your dividend in cash, right? So that's obviously an option. So you get the cash payments, and that's a great thing about income. You can do whatever you want, right? Back when you could leave your house, you could go to the mall, buy something, happy days. So here's what happens in Transurban if you are taking your dividends in cash. Now, what you'll see is between 2009 and 2017, things went really well, right? You had a growing dividend, so you kept getting more and more money. You can see the growth rates there. Every single year this grew. The other option, of course, is dividend reinvestment, this DRIP plan where you can reinvest it in shares. So what I did is I went through and I looked at what happened with shares. So how many additional shares were you going to buy? So see, with this dividend, you got 27, et cetera. So what does this mean? Well, at the end of this period, you can look at what the total income would be and the growth rate of the income versus what the total income would be here. Now, of course, every time you're buying more shares, you're going to get more dividends as long as they are the same or growing. In this case, they're growing, so you're going to compound that income growth. So it's just an example of one, the power of dividend reinvestment, and other, just the consideration. This is if you bought 1,000 shares at $5,000 back in August 2009. So it's just showing the different considerations and how much faster you will compound if you are reinvesting your dividends, compounding that income, and if, of course, those dividends are growing. Now, you'll compound those faster even if they don't grow, but especially if they're growing, you're getting more and more shares, that dividend's growing, something to think about. All right. We have lots of questions. We'll get to the questions. I will get to those in a second. And we have stuff in the chat. Okay, I think I put this in the wrong order. So I have all sorts of problems today, as apparently does New South Wales. So, okay, let's talk about franking credits. This should have come after the franking credit discussion. So what we talked about is 2% a year, right? On average from the ASX 200, that you're getting 2% additional growth a year from franking credits. Now, everyone thinks, okay, and we hear this a lot, why would I ever invest overseas? Because franking credits are so high here. Well, a couple things. So number one, this is payout rates. So payout rates in Australia are a lot higher than they are everywhere else. And the reason for that, or what a payout rate is basically of $1 of earnings, what percentage is paid out to shareholders in a dividend. Now, there is this preference because of franking credits for dividends in Australia. Whereas in the US, a lot of companies will mix the capital they give back to shareholders between buybacks and dividends. So a buyback is simply when a company goes out and buys shares on the open market, which in theory, the way it should work, is then you have lower share counts, which mean you as a shareholder own more of the company and you are entitled to more of the profits, right? So share buybacks can be very good. The problem is what happens with a lot of companies is the share buyback just covers up dilution. So in the opposite way, if you have more shares, every shareholder has less of the company, less of an ownership stake. And the reason this dilution is happening is because they're giving options to executives as part of compensation. So these share buybacks, they'll announce, these technology companies do this, they'll announce these giant share buybacks, and then you go and look at the total number of shares and they don't move. Which means when they go out there and they say, we're buying back $5 billion worth of shares, if you're like Facebook, they'll turn around and give $5 billion worth of shares to their executives. Which is fine, right? You need to pay people, but just remember that sometimes that headline number doesn't work. So one of the good things about dividends is that they're tangible, they're real, and that you do get them. Okay, let's go back to this example of going abroad. We have a James Joyce quote, just because, I don't know, I was just putting quotes in here last night. You can tell the nice slides that Shani put together, just like the picture of me, and then the ones I did. All right, now, franking credits are in Australia. Why would you want to invest overseas? Well, we talked about some of the reasons, but the other reason is, all right, if you go back and look over the past 10 years, so remember, we're looking at this compounded annual growth rate. You get 2% extra for franking credits. Well, the interesting thing is the S&P 500, 500 biggest companies in the US, over the last 10 years, grew more than 2% faster, all right? So even with franking credits, including franking credit, well, it doesn't matter, 2%. Even with franking credits, 11%. In Australia. That's including franking credits. S&P 500, no franking credits, but grew close to 14%. The other thing is, and this also has to do with this dividend payout rate. So once again, the payout rate is good because that means you're getting higher dividends, but the company also is giving more cash out as dividends. I talked about buybacks. The other thing they can do, of course, is invest that in the business and try to grow the business. So if we look at the average dividends per share growth rate over the past 10 years in the ASX, 3.4%, close to 10% in the S&P 500. So you're getting a lot faster growth. You're not getting franking credits, but you're getting a lot faster growth. You're getting higher returns. So only the last 10 years. And you're getting lower yields right now. So just remember that those are trade-offs. So, by saying that you're only going to invest in Australia because of franking credits, there are trade-offs. So just remember that. Now, obviously, this was the last 10 years. We have no idea what's going to happen in the next 10 years. The S&P 500 could go down 10% a year. The ASX could go up 50% a year. I don't think either of those scenarios are probably likely, but it could happen. All right. 2 more slides to get through, and then we'll just do lots of questions. Not that I know what time it is. All right, we're doing pretty well. Okay, let's talk about dividend sustainability. So what's really, really important when you're looking at dividends? Well, are they going to keep getting paid? So remember, the difference between dividends and interest that you get from fixed interest, for example, is that is a contractual obligation. The company has to go out of business to not pay you back if you own a bond. A dividend is a choice by management. It's based on a lot of factors, but one big factor is, are they able to actually pay you the money? So things are not going well for the company. They may not pay you a dividend. So we all experienced that last year in 2020. So a lot of companies deferred or temporarily suspended their dividends because of what COVID did. So basically they were worried about future revenue and the economy. They had a giant drop in revenue depending upon what business they were in. So a lot of people suspended those dividends. Now that can happen at any time. So the problem with dividend investing is you need to make sure it's sustainable. So what are some different factors you can look at to see if this dividend is sustainable? The one thing you can look at is the Morningstar Economic Moat Rating. So the quality of the company. So basically a moat means that it's a sustainable competitive advantage. Not many companies have them. So if you have that moat, that protects your company. It protects the margin that your company makes, which we'll get down to in a second. So the margin is the difference between revenue and income. So basically, are you able to make a lot on everything that you sell or a little bit on everything you sell? So a high margin would be, I buy a Coke for $1, I sell it for $2. Low margin is I buy a Coke for $1, I sell it for $1.10, right? So that's lower margin. So margin's important, and you protect that with the sustainable competitive advantage. People can't undercut you in price. You can also protect market share, right? So that your sales are going to continue to grow and not get eroded by competition. So economic moat's important. Organic revenue growth. Okay, so of course, if the company is growing revenue, that's a good thing. So they are selling more stuff. Selling more goods and services. So that's a really good thing if you are a dividend investor, because if they're selling more stuff, then hopefully they'll be able to pay you back. Now, the reason we said organic revenue growth means that you are just growing that from your existing business lines, as opposed to going out and purchasing another company. And you're like, oh, our revenue growth went up because we just spent, if you're Square, $39 billion on Afterpay. Right? So that's an example of revenue growth that's coming from paying a lot for another company. It's very different than organic. It just means your business is naturally growing. Customer concentration. So you're looking at all the different risks, basically, to the business model of this company. If you've got one customer, that's a problem. You got to keep that one customer happy. If you are, once again, to use the Coke example, if you have 1 billion customers, it's fine. You lose one, not a big deal. So looking at customer concentration is important. Recurring revenue. So what is recurring revenue? Recurring revenue is like if you have a Netflix account, so that you don't have to go out there and make every sale. So that's a very hard business to be in, where every single sale involves you going out and putting effort into it. It's much better if people sign up on these contracts and they're longer term contracts, and you just have this recurring revenue every year, right? So if you're Netflix and you get somebody, you get your hooks in somebody, they're probably just going to keep paying their bill. Margin compression we talked about. So that's a worry, right? If you're seeing margin compression, that could be an issue for dividends. The dividend payout ratio. So dividend payout ratio, once again, you were looking at how much they are paying out of their earnings. So a dividend payout ratio of 50% means that they're earning $1 in earnings, and 50% of that, 50 cents of that is going out to shareholders in dividends. So that's a dividend payout ratio. Now, the higher that is, the less the less stable the dividend is. If you have a dividend payout ratio of 99, right? So 99 cents out of $1 is getting paid out. What happens if your earnings fall a little bit? Well, then your dividend will be higher than your earnings. Where if it's 50% and you lose 49% of your earnings one year, you're still covering that dividend. Now, the caveat for this is, which I talked about on Tuesday, I won't go through the whole thing again unless somebody asks a question. There are certain industries that can sustain very high dividend payout rates that can be in excess of 1. Those are industries that, like real estate, for example, with high fixed assets, because they have a lot of non-cash charges like depreciation that are going to impact earnings. So their cash flow will be higher than earnings, and they can pay out dividends from that cash flow. The cash is the important thing. So I won't go through that whole thing. If somebody has a question, let me know, and I can go my little Qantas example, which I always give. So think about that. So over 90%, yeah, might be unsustainable. But what I would do is, if you see a dividend payout ratio that's very high, go look at other companies in that industry. And if they're all really high, it could be an industry that has high fixed assets. Once again, like real estate, infrastructure, utilities, things like that. So something to think about. Finally, financial strength. So of course, because this is a choice, management needs to be able to make that choice to pay out a dividend. If the company has a lot of debt, that of course is going to take away their flexibility. So what are some of the things you're going to look at? You want to look at their balance sheet. So look at their net debt. So you can go look at the liabilities, so all the debt that they owe versus their cash. A really safe company is a company that has no net debt. So a lot of these tech companies in the US have, $150 billion in cash sitting on their balance sheet and maybe $30 billion in debt. So that is great. And in the podcast episode that's coming out Sunday, we talk about, I think we use Microsoft as an example, has a ton of cash, very low debt compared to that. What does that mean? It means that, of course, they've got all this cash to help pay out dividends if they choose to do that, even if their earnings fall. But not a lot of companies are like that. But the other thing you can look at is debt maturity schedules. If they have a lot of debt, when is it maturing? If it's maturing in the near term, they might have to put a lot of their cash flow into paying that off. They have to give the money back to the bondholders. So that's something to look at. Interest coverage ratio, can they cover? What's the degree that they can cover even the interest payments that they have to make to bondholders? Debt to equity ratios, or looking at debt versus equity that they have. High debt to equity ratios could be a problem. They could not have the financial strength. At Morningstar, you can go look at our capital allocation rating that we have for all of the securities that we cover, and that will describe what our analysts believe kind of financial shape they're in. So, it all makes common sense, right? Like at the end of the day, if two people come up to you and want to borrow money for you, and one is swimming in debt, in credit card debt, and, has no cash versus another person who has a ton of cash and no debt, who do you think is going to pay you back? Well, the person with all the cash and no debt. So remember that. All right. So I'm going to give you some ideas of Aussie equity dividend ideas. So today we came out with a new, and this actually was a coincidence, but a good coincidence. Our equity analyst here came out with a new report, and I'll show you where to find it, a new report on income investing in Australia. So yeah, it was a good timing. So if you're a premium subscriber, I'll show you where you can get it. If you're not a premium subscriber, send me an email and I'll send you the report. So it's mark.lamonica1@morningstar.com. Just, to be generous for today. All right. So what did we do? We went through and we screened all the companies under our coverage. What did we do? We removed companies with no economic moat. Remember, we think moats are good in terms of sustainability of dividends. We removed companies with poor capital allocation. So capital allocation rating is one of the ratings that our analysts have, where they look at the financial strength of their company and how management allocates capital. We took out Kiwi companies because franking credits and, all of that. So a lot of this report talks about, and I got some of the stats in here, talks about franking credits and sort of basically the power that they have, and that franking credits can actually adjust the fair value that you would pay for a company. Now, we don't adjust our fair values by franking credits because that's assuming a certain tax structure. or basically certain tax conditions, like you're a domestic investor. We're a global company. But this report talks about how franking credits can actually change that fair value of a company. We took out 1 and 2 star. We looked at gross yield. So including franking credits, we looked at what are you actually getting. So we're looking for high dividends that are safe. So this part's safe. That's high yield. We removed expensive companies that get 1 and 2 star ratings, so that are trading at significant premiums to our price to fair value. And we prioritize wide moat stocks. And there's a list. All right, so I'll leave the list up for a second while we talk. And there are write-ups in all of these in this report. So once again, I'll show you where to get it on premium, and then we can go, and if anyone wants it, they can just email me. A couple things. So because this gets put on YouTube, I don't know what day it is today. It's August 5th or something like that. It's early August. So remember, everything that I've said today is based on early August in terms of these, and valuations change. All right, so let's quickly go to the website, and I'll show you where to find this stuff once I find the website. And then we'll get to everyone's questions. And there's one other question related to the website that I can show off as soon as I can find the website. What is this? No, I was looking at something else. COVID related, since that's in the news. There we go. Now we got the website. All right, number 1, for anyone who's a premium subscriber, if you want to find this report, go to Stay Informed. That's the home of our editorial content. And then go right here, 10 franked income stock ideas for Australian investors by Gareth, who's one of our analysts. Click on that. Here's the report. So you can go in and read it. So anyone who's looking for this full report that came out today, is today the 4th, or came out last night? Today is the 5th. I knew what day it was, so that's an accomplishment. The other, we have a question on here. Matthew's asking about hybrids. So we do have hybrid research. Now, we have outsourced our hybrid research to a company called Bond Advisor. So if you go into security type, on Discover Investments, security type, this is where our research is. You can go to hybrids. So basically, this is the list. So we cover 48 different hybrids. These are the hybrids that we cover. So you can see it's been a little bit. We haven't had any come out since July, but as you can see, they're mostly dominated by banks. So you can go read the research on hybrids. So if you are interested in hybrids and you want to learn a little bit about them, this thing open there. You can go read Bond Advisor. Basically, a Morningstar analyst went to Bond Advisor, or 2 analysts there at Bond Advisor, so we just outsource our research to them. But if you do want to learn more about hybrids, you can go there. So anyway, I hope the rest of your day goes better than mine. But thank you for joining. I'll be back on Tuesday talking about something else. I don't remember what it is. Maybe it'll be interesting. But thank you guys for joining. I hope everyone is healthy and safe.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.